Okay, so let's talk about Morgan Stanley. At the start of 2026, you've got this head-scratching situation going on. On one hand, the company is absolutely crushing it, posting the best profits in its history. But on the other hand, they're cutting thousands of jobs. It's a contradiction that really gets to the heart of how Wall Street works today, and we're going to break it all down.
First, let's just look at how good things are for investors. In 2025, Morgan Stanley hit an earnings per share of $10.21. Now, that's not just a good number. It is quite literally the highest EPS the firm has ever recorded. It was a historic year, plain and simple.
But then, almost in the same breath, you get this news. 2,500 people are gone. And look, this isn't just trimming the fat. This is a major cut, hitting every part of the company, all the way from their headquarters in New York to their offices in Mumbai.
So you have to be asking yourself, how can both of these things be true at the same time? How can a company be on top of the world financially while also letting go of thousands of people? That's the real story we're digging into here. What this says about their strategy and where they're headed next.
To really understand what's happening, you have to realize that the Morgan Stanley of today is a completely different beast than it was 15 years ago. It's gone through this massive but kind of quiet transformation that's changed the very foundation of how it makes money.
And hey, don't just take my word for it. The new CEO, Ted Pick, he came right out and said it. The transformation is done. This wasn't some accident. It was a deliberate 15-year plan that has finally come together.
And this chart right here, it tells the whole story. If you go back to 2010, the steady, reliable business of managing people's money, that was only about a quarter of their revenue. But fast forward to today, and it's more than half. They've intentionally pivoted away from the risky, up-and-down world of big deals toward building a stable, money-making machine.
So the way management talks about the company now is that it's like a two-engine jet. The first engine, the one that provides all that smooth, steady power, is their giant wealth and asset management division. You could say this is the bedrock of the whole firm.
And when I say giant, the scale is just staggering. We are talking about $9.3 trillion in client assets. This engine isn't just big, it's colossal. It just keeps pumping out steady fee income quarter after quarter, no matter how wild the markets get.
And if you want to see just how powerful this is, look at this milestone from just this past March. They officially crossed $1 trillion in assets held just in individual retirement accounts, or IRAs. That's what the industry calls sticky money. It's people's retirement savings. It's not going anywhere, which creates an incredibly solid foundation.
And get this, the wealth business isn't just huge, it's actually growing faster than its rivals. Since 2022, their IRA assets have been growing at nearly 16% a year. That's way faster than the industry average. So they're not just big, they're actively taking a bigger piece of the pie.
Okay, so that's the reliable cruise engine. Now let's talk about the second engine. If wealth management is about stability, the investment banking and trading division is like the afterburner. It's more unpredictable, sure, but when you kick it into high gear, it delivers incredible power. And right now, it is absolutely screaming. Just look at this number. In the last quarter of 2025, investment banking revenue shot up by a staggering 47% from the year before. You know, for a couple of years, deal-making was in a real slump. Well, the floodgates have finally opened, and Morgan Stanley is right there to cash in.
But this isn't just the market getting back to normal. A huge piece of this explosion is being driven by the global race to build the infrastructure for artificial intelligence. And Morgan Stanley has put itself right in the middle of it, becoming one of the go-to banks to finance this whole tech revolution.
And their dominance isn't just in advising on big M&A deals. It's on the trading floor too. In 2025, their equities trading revenue grew by almost 28%. And you know who they beat? Their biggest rival, Goldman Sachs. So yeah, both engines are running red hot right now.
So, with two engines firing at full blast and profits at an all-time high, the story sounds pretty perfect, right? Well, not so fast. If you start to look a little closer, you can definitely see some cracks in the armor.
So while the equities team is celebrating, there's another part of the trading floor that's really struggling. Revenue from FICC, that's fixed income, currencies, and commodities, actually fell almost 9% in the fourth quarter. That's a pretty serious drag on the bottom line, especially when a lot of their competitors are doing better. It's a real weak spot in what otherwise looks like a flawless report card.
Which brings us right back to that big question. If the business is this good, why on earth are 2,500 people out of a job? The answer, really, comes down to a relentless, almost obsessive focus on efficiency and keeping shareholders happy. In this new Morgan Stanley, even when times are great, the company is always looking to optimize, to cut costs, and to shuffle people around to the most profitable parts of the business.
But behind all that corporate jargon about efficiency, there's a very real human cost. This quote from a Reddit thread talking about the layoffs just makes it painfully real. For every little percentage point of profit margin they squeeze out, there's a story like this: a loyal, long-term employee whose life just got turned upside down.
And that intense pressure to optimize, it's there for a reason. Because despite all this success, there are some very real risks to keep an eye on. That big wealth management engine, it's facing pressure on its profit margins as costs go up. The investment banking engine, it's still super sensitive to a sudden market downturn. And that weakness in FICC trading, that's not just going to magically disappear. So this perfect machine absolutely has its vulnerabilities.
So what's next for Morgan Stanley? Where do they go from here? Well, management hasn't been shy about it. They've laid out a super clear and frankly very ambitious plan for the future that combines the power of both of those engines.
Here's the game plan. First, they want to keep feeding that wealth funnel to pull in even more clients. Second, they're laser-focused on pushing profit margins up to 30% or more. Third, keep dominating when companies want to merge or go public. And finally, figure out how to make serious money from their new AI and digital tools. It's a plan for complete and total optimization.
And all of this, it's all building towards one massive, audacious goal: hitting $10 trillion in client assets. See, this isn't just about being a top investment bank anymore. The real endgame here is to become the #1 undisputed king of wealth and asset management on the entire planet.
And so that's what we're left with. Morgan Stanley has spent 15 years building what they believe is the perfect financial machine. It's incredibly powerful, it's efficient, and it makes an insane amount of money. But as it chases that $10 trillion dream, the real question is whether it can handle its own contradictions. That tension between record profits and the human cost, and between dominating the market and ignoring its own hidden risks. That right there is going to be the defining story for the new Morgan Stanley.